Equity markets focusing on the U.S. Fed minutes going to be released later today, 2 p.m. Eastern time. For some perspective, we head to Chicago and Trent Wagner. He is executive director of the Fox Group. And we want to hear, Trent, from you. What are you expecting, or rather, what are the equity markets expecting from these minutes?
Personally, I'm not expecting an awful lot of fireworks this afternoon, Greg. Yellen talked last week at the IMF meeting. I'd be really surprised if anything in these minutes dispels any of the sentiment that she had last week. Collectively, just on the June update that we had with the FOMC forecasts, if you look at unemployment, you look at inflation, Fed funds rate, collectively the committee does feel the economy is better off than where they felt it was 3 to 6 months ago. But that can be mutually exclusive in the near term as to when they're going to raise rates, which is really what everyone is going to be looking for with the minutes today. So I'd be surprised if we had any sort of real fireworks. I think they'll stay with the status quo. I think they'll be fairly conservative with this communication as to not spook the markets.
With a few new voices around the table, is there a possibility, even if it's slight, for perhaps a little divergence, a little more than we're used to from the minutes?
I don't expect that. I think if anything today, there might be slight changes in the verbiage used in the minutes, something like moderate to very. They may talk about inflation. It certainly has picked up on the metrics. I don't believe that that's necessarily on the forefront of their concerns in the immediate term. Just a few months ago, they were worried about a landscape of rates being too low for too long of a period. So I don't think the inflation has picked up that much that they'll have that as a main focus in this communication. I think there's going to be divergence as always, not necessarily any more than what we've seen over the past few months.
Now, you always wonder about how deeply investors will read into any of the tea leaves they see because, of course, as you were saying, rates front and center. And there's been a lot of bets lately. And we've seen some market action on those bets going up and down based on when they think the rates are going to come. Do you guys sort of any viewpoint of how the Fed is, are they in any position to sort of move forward that rate raise?
I know what we're going to be looking at, Greg, and it's going to be if they come with any sort of communication as to specifics that they are looking for within the labor market that would justify them raising rates sooner rather than later. When they originally put forward with their plan for the forward guidance, they tried to tie that to the unemployment rate at 6.5%. As we neared 6.5%, the communication softened very much as far as we're going to base a rate increase on the unemployment rate. So that there's something in the employment market, in that labor market, that they just don't like at this point in time, whether that's the participation rate, whether that is average wages not going up as much as they'd like to see. That's what we're going to be looking for, is if they get specific with what it is they'd like to see in the labor market that would justify them raising rates sooner than what is currently thought.
Now, Alcoa kicks off earnings season, kicks it off with a beat. We're seeing a little bit of buying today after a heavy day of selling. What drives the bus going forward? Is it all this concern about when rates are going to rise, or is it actual company earnings?
I think it's going to be company earnings, and that's a caveat to that would be assuming that the communication from the Fed today comes out as I think it will, without any fireworks. But I think once we get the Fed minutes out of the way, it certainly will be a focus on earnings season here. If they come in well, which, I mean, right now I feel the equity markets are fairly priced based on what we've seen through the first 2 quarters of the year. So if there is any sort of a pause in the equity markets, I mean, we haven't had really any retracement in the S&P to speak of since mid-April. If we do have some earnings misses, that could provide a catalyst for maybe a 4 to 5% correction here in the near term. But I certainly would say, based on what I feel the communication from the Fed would be today, that the shift of the focus will go to earnings fairly quickly after this afternoon's minutes are released.
Trent, quickly, I want to ask you, only about 10 seconds left, but when you're talking the S&P 500, you have a call that it could go to 2150 by the end of the year. Is this steady gains winning the race, or is this a big jump at any point?
I think it's steady gains, and I believe that there will be a better point to enter on the long side in the next few weeks than where we're at now. But when the smoke clears at the end of the year, I think the central banking policies worldwide, not just here in the U.S., but Europe, Japan, essentially they're funneling money to riskier asset classes, and thus far stocks have been a pretty big beneficiary of that. I don't foresee that landscape changing too much as we enter into the last 6 months of this year. So there may be a couple bumps in the road, but I'd be surprised if we weren't somewhere between 2,100 and 2,150 at the end of the year.
Fascinating call. Thanks for your time today, Trent.
Appreciate it, Greg.
That was Trent Wagner. He is Executive Director of the Fox Group.